In 2008, the richest country on earth woke up one morning and realized the money was gone. Not stolen, not lost, just gone. Evaporated like it never existed. Banks that had stood for over a century collapsed within days. Millions of families came home to find padlocks on their front doors. And the men who caused it? Most of them walked away with bonuses. This is not a story about numbers. This is a story about greed, lies, and what happens when the most powerful financial system in human history is built on a foundation of sand. Welcome back to Epoch Stories, where we take the defining moments of history and put you right in the middle of them. If you're new here, welcome to the family. You're going to want to stay for this one. To understand what crashed in 2008, you have to understand what was being built in the years before it. Through the 1990s and into the early 2000s, America was riding a wave of confidence. The economy was growing. Jobs were plentiful. And more than anything else, people believed in one idea with almost religious devotion: that buying a house was the safest investment a person could ever make. Home prices, they said, never go down. Banks were handing out mortgages like candy on Halloween, not just to people with steady incomes and solid credit. To anyone, a truck driver, a waitress, someone with no job, no savings, and no realistic way to ever repay the loan. It didn't matter. The banks approved them anyway, and they had a very specific reason for doing that, because they had no intention of holding onto those loans. What was happening behind the scenes would take years for the world to fully understand. But once it unraveled, it would bring the entire global economy to its knees. Here is how the machine actually worked. When a bank gave someone a mortgage, they would bundle thousands of those mortgages together and sell them to Wall Street as investment products called mortgage-backed securities. Wall Street would then sell pieces of those bundles to investors all over the world: pension funds, insurance companies, foreign governments. Everyone was buying them because the returns were excellent. And the rating agencies, the companies that were supposed to evaluate how risky these products were, kept stamping them with the highest possible safety rating. AAA, the safest thing you could own. Safer than gold, they said. But here's what nobody was saying out loud. Many of those mortgages inside those bundles were already rotten. They had been given to people who could not afford them. And when the interest rates on those loans eventually adjusted and the monthly payments doubled overnight, millions of Americans would have no way to pay. The machine was running at full speed, and it was heading straight for a wall. By 2006, warning signs were already flickering for those paying close attention. A small number of hedge fund managers and analysts began to notice that the housing market was not just slowing, it was quietly cracking. Default rates on subprime mortgages, loans given to the riskiest borrowers, were beginning to climb. A few brave voices started to speak up. They were largely laughed at. One man, a physician-turned-investor named Michael Burry, had studied the mortgage data so carefully that he became convinced the entire system was fraudulent. So he did something almost no one had ever done before. He bet against the American housing market. He effectively took out insurance policies that would pay out massively if the mortgage bonds collapsed. Wall Street thought he was insane. They would not be laughing for long. By early 2007, the cracks became impossible to ignore. Subprime mortgage lenders began shutting down one by one. Foreclosure rates were spiking across the country. Families were walking away from homes they could no longer afford, leaving entire neighborhoods looking like ghost towns. And yet, the official message from Washington and from the banks themselves remained calm. This is a contained problem, they said. A speed bump. Nothing to worry about. But what happened next changed everything. In the summer of 2007, two hedge funds managed by Bear Stearns, one of the oldest and most respected investment banks on Wall Street, completely collapsed. They had been heavily invested in mortgage-backed securities. When those securities lost their value almost overnight, the funds were wiped out. Billions of dollars. Gone. Bear Stearns tried to reassure its clients. The firm was fine, they said. There was nothing to worry about. That was a lie. And within months, the world would know it. If you're finding this story as gripping as I think you are, take a second right now to hit that like button. It genuinely helps this channel grow and keeps stories like this one coming. If you haven't subscribed yet, join the Epic Stories family and never miss a moment of history. By March 2008, Bear Stearns was finished. A bank that had survived the Great Depression, 2 world wars, and decades of financial storms collapsed in a matter of days. The U.S. government organized an emergency sale to J.P. Morgan Chase at $2 a share. A company once worth over $170 a share was sold for almost nothing. It was a brutal warning of what was coming. And still, many refused to see it. Then came September 2008, the month that changed the world. Lehman Brothers, one of the most powerful investment banks in history with 158 years of operation behind it, filed for the largest bankruptcy in American history. $613 billion in debt. Gone overnight. The government, which had just rescued Bear Stearns, made the decision to let Lehman fall. To this day, economists debate whether that was the right call or the single worst financial decision of the 21st century. The markets went into free fall. In a single week, the stock market lost trillions of dollars in value. Banks stopped lending to each other because they couldn't trust whether the bank sitting across from them was about to collapse too. Credit markets froze. The engine of the global economy simply seized up, and ordinary people paid the price. Within months, 8.7 million Americans lost their jobs. Nearly 10 million families lost their homes. Retirement savings that people had spent decades building vanished. The unemployment rate nearly doubled. And the pain didn't stay in America. It spread like a virus, crashing economies in Europe, Asia, and beyond. Iceland's entire banking system collapsed. Greece was pushed to the edge of national bankruptcy. Factories in China shut down. The global economy contracted for the first time since World War II. Meanwhile, the U.S. government launched what became known as the bailout. Congress approved $700 billion to rescue the very banks whose recklessness had caused the disaster. The same banks that had approved fraudulent loans, packaged them into toxic products, and sold them to the world with a smile. Many of those same executives still received their bonuses that year. The public rage was volcanic, and it would shape politics across the world for the next decade. So what did we actually learn from 2008? New regulations were introduced. The Dodd-Frank Act attempted to place guardrails on the financial system, forcing banks to hold more capital and limiting some of the riskiest behavior. The Federal Reserve expanded its powers. International financial oversight was strengthened. But here's what keeps historians and economists up at night. The fundamental incentives that created the crisis, the rush for short-term profit, the disconnect between risk and consequence, the belief that certain institutions are simply too big to be allowed to fail. Those forces were never truly eliminated. They were managed. They were regulated around the edges. But the engine is still running. And every few years, someone who was there in 2008 looks at whatever new financial product is being celebrated and feels a quiet, familiar chill. The 2008 financial crisis was not just an economic event. It was a mirror held up to the soul of modern civilization. It revealed what happens when a system built on trust is quietly hollowed out by greed. It showed that the most sophisticated financial minds in the world, armed with the most advanced computer models in history, could convince themselves that a lie was the truth simply because everyone around them was repeating it. Millions of ordinary people lost everything they had built, not because they gambled, not because they were reckless, but because they trusted a system that had already decided they were acceptable collateral damage. That is the part of the story that no documentary on Wall Street will open with. But it is the part that history will not forget. If this story moved you, share it with someone who needs to hear it. Drop a comment below and tell me, do you think we actually learned from 2008, or are we still building the same house of cards? I read every single comment, and I would genuinely love to know what you think. Subscribe to Epoch Stories if you haven't already. Every week, we bring you the moments in history that shaped the world you're living in right now. And trust me, you don't want to miss what's coming next. Until then, keep questioning everything.